Hey there, it's great to be with you today. As a real estate agent in Tennessee, I've seen many clients get excited about the prospect of buying their dream home, only to realize that they're not quite ready to talk to a lender. That's why I wanted to take a few minutes today to talk to you about what you need to have prepared before you even approach a lender. By being proactive and organized, you'll be able to get the best rates and the best loan options available, and you may even become your lender's new favorite, since you'll be such a pleasure for them to work with.
Did we just become best friends? Yup!
So what do you need to have prepared? Here are some key things to keep in mind. First, you'll need to prove your income and employment history. Lenders need to know how much money you make and how long you've been employed because this gives them information and a sense of your financial stability. The longer you've been employed and the more money you make, the more likely you're going to be able to repay the loan. This is important for lenders because they want to make sure that they're lending money to borrowers who are likely to be able to pay it back. Gather up your most recent pay stubs and tax returns to help prove your income and employment history. The magic number here is 2. Ideally, you will have worked in the same company or a similar role for a minimum of 2 consecutive years. You may ask, what if I'm fresh out of college? Good news, that counts too. Second, have an idea of your debt to income ratio. This is a calculation that takes into account how much of your debt you have compared to how much money you make. Lenders want to see a debt to income ratio of 43% or less. The closer to 30% or under, the better. This matters because the ratio indicates that you have enough income to cover your debts and still be able to afford a mortgage payment. If your debt to income ratio is too high, it may be a red flag to lenders that you're already stretched too thin financially, which could make it more difficult for you to make your mortgage payments. If you have a lot of debt, you may need to take a few steps to pay it down before you apply for a loan. I often encourage my buyers to have a conversation with my preferred lender anyway, without having a hard pull on their credit, because most lenders can run what I refer to as a what-if scenario and basically help you navigate which debts you're going to need to prioritize first in order to help get your ratios in a better place to buy. Now that we're at the halfway mark, can you do me a quick favor and hit that like button for me to help more beautiful people like you find this video? Thank you very much. Moving right along. Third thing, your down payment. Your down payment is important because it shows the lender that you are financially invested in the property. The more money you put down, the less risky the loan is for the lender. A larger down payment also means that you may be able to get a lower interest rate or avoid paying premium mortgage insurance, PMI. Depending on the type of loan you're applying for, you'll most likely need to have a down payment already saved up. The amount of your down payment will depend on the type of loan, your income, and your lender's requirements. Be prepared to have at least 3 to 5% of the purchase price saved up minimum. Most conventional loans can range up to 20%, and land purchases with intent to build can range from 20 to 25%. No worries, your hard-earned savings won't leave your bank account until after you've signed on closing day with the property of your dreams. Reminder from other videos, think about simply rolling that down payment into a savings account you get to live in. Lastly, your credit score. When a lender looks at your credit score, they are trying to assess your overall financial responsibility. A good credit score demonstrates to the lender that you're a responsible borrower who pays their bills on time and manages their debt well. This is important because it tells the lender that you're a low-risk borrower, which makes them more likely to offer you lower interest rates and better loan terms. In short, all of these items are important for the lenders because they help the lender assess your financial stability, ability to repay the loan, and overall risk as a borrower. So there you have it. A few key things you need to have prepared before you talk to a lender. By being proactive and organized, you'll be able to get the best loan options available and increase your chances of getting pre-approved for a mortgage. If you have any questions about the home buying process, drop them in the comments below or connect with me on Instagram where I interact daily. Thanks for watching, and I'll see you in the next video.